Welcome back. We were dealing with inflation before the war against Ukraine started. The war is making things worse, from sinking stocks and retirement funds to rising mortgage rates, rising gas prices, rising prices at the grocery store. It is certainly a challenging time. We asked Professor David Sacco of the University of New Haven to join us to help us understand what's happening. Professor Sacco, thank you so much for being with us. Obviously, this is, as we said in the intro, a challenging time. But I saw the president of the World Bank called this Russian invasion of Ukraine a catastrophe for the global economy. Do you agree?
Well, it's certainly a big shock. The global economy was just recovering from the pandemic, and we were dealing with the supply shock related to the events surrounding the pandemic. And certainly we didn't need another external shock like this. So I would say that's a pretty accurate assessment.
What have you seen as this has played out over the last few weeks? How do you evaluate what's going on? There's been so many ups and downs and things changing on maybe a little glimmer of hope and then bad news. What do you do to evaluate what's happening, say, on the stock market?
Well, times like this just create volatility. So we see stock prices swinging up and down every day, gasoline prices going up and down and every day, and prices are just mostly going up. And inflation, which has been a problem even before this event happening, continue to get upward pressure. What I would recommend to most people is, you can't react to the day-to-day changes and things. Obviously, it's a very precarious time, and you just need to be cautious in your approach and just realize that, in the long term, things usually tend to even themselves out. But in the short term, we're going to have some volatility, and you have to prepare for it.
Well, let's unpack a few of those different topics that you just talked about. I'm sure many people who are watching this especially closely is people looking at those 401ks and other retirement accounts if they're getting close to retirement age. Long term, things do tend to flatten out. But what's your advice to people who might be nervously hitting refresh a couple times a day on that app?
Well, you make a great point. So in the last 5 years, roughly the value of the Dow Jones Industrial Average has pretty much doubled, right? It was about 17,000 sort of at the end of 2016, and we're still up at over 33. So even, people who are 10 years away from retirement, 5 years away, I wouldn't worry too much. You'll have plenty of time to recover. If you're closer and you're getting nervous, there's nothing wrong with pulling back some money now because you're still up quite a bit over the last few years, right? You may not be at the highs that we were, but you've still got pretty good gains in there. So don't be afraid to take a little risk off the table, because at times like this where we have increased volatility, there is more risk. And the closer you are to retirement, the more likely you are to be better off by paring down your exposure a little bit. So I think it's the time horizon is the key. If you're 10 years away from retirement, don't worry. If you're closer, maybe pare back a little bit.
One of the other areas you mentioned is oil prices. And we've seen over the years when there is any sort of crisis that affects oil prices, be it a hurricane, an armed conflict like this, the oil producers tend to self-correct eventually. Is that something we're watching for, that eventually there will just be more supply? Or is something like cutting off the use of Russian oil such a big shock that this may be a prolonged change?
Well, it's a big shock on its own, but then coming on the sort of supply shocks that we've had over the last few years and the ramp up in demand since we kind of started, coming out of the COVID recession a little bit has exacerbated things. Combine that with, there's a lot of pressure related to carbon energy and clean energy. So there's a couple of things going on, right? You've got governments around the world using regulation to try to slow oil production in the sense that we want to move to cleaner energy. But you've also had the investing market. So investors have been a little bit tougher on oil companies in the last few years, because typically when the price of oil goes up, companies start spending more money investing in new technologies to extract more oil out of the ground. And then when oil goes back down, those capacities go unused. So investors have been questioning oil companies in terms of that, sort of yo-yo strategy, which, maybe don't invest as much because ultimately the price does come back down, and then you sort of have an inefficient use of capital. So I think it's a combination of those two things, that sort of have exacerbated this a little bit.
Well, you talk about the COVID correction. I want to talk about mortgage rates a little bit. We saw the Federal Reserve say that, to battle inflation before this Ukraine conflict started, they were talking about maybe inching up on some of those rates, and the mortgage market reacted. My real job during the week is being a lawyer, and I do tons of closings, and I know everyone in that area is watching so closely. The rates came up. Now they've gone back down. What do we expect long term for mortgage rates?
Well, as you said, the Fed is behind the curve when it comes to battling inflation and raising rates. Now, the biggest tool the Fed has to raise rates is they typically raise very short-term interest rates. They have been influencing long-term interest rates over the last few years through asset purchases, which they'll be unwinding. So in all likelihood, interest rates are going to go up. but I wouldn't expect them to shoot up. So, therefore, I would expect the impact in the housing market to be, somewhat minimal, because I think the underlying forces that have sort of pushed people into moving away from cities, and the whole, concept of you can sort of live anywhere and do most jobs now, or certainly a lot of jobs. I think that's going to keep real estate prices somewhat firm, but they'll see, a little bit of headwinds as rates go up. The flip side of that is the rental market's gotten very high. So rents are very high, which still makes buying a house and financing with a mortgage attractive. So I would expect there to be a muted impact, but I wouldn't expect it to severely impact the housing sector in the short term.
We only have about 30 seconds left, but I want to ask you about the corporate exodus we've seen from Russia. A lot of companies, big companies, Fortune 500 companies saying, forget it, we don't support this invasion and we're pulling our shops out of your country. It's kind of unprecedented. And what do you make of that as a corporate strategy?
Well, I think it sends a good signal on their part that they obviously care about the Ukrainian people. At the same time, the Russian economy is the size of Canada's economy in terms of GDP. So they're not really risking losing a large part of their business by doing it. And in fact, the positive benefit they may get in terms of the messaging it sends might help them increase their business in other countries. So, I think they're trying to do the right thing. The only concern is if you're penalizing Russian consumers, that's not getting Putin necessarily, and they're not the ones who started the war. So.
No, certainly something that we will continue to watch, just as we all watch those stock market prices going up and down. Professor David Sacco from the University of New Haven, we appreciate you being with us here on CT22.
Thank you guys very much.